The city of Los Angeles has a new tax called the mansion tax. When people were voting for this, they were assuming that this will apply only to really big properties, mansions, but it includes all sorts of properties, including affordable housing and commercial real estate. Our guest today is Mott Smith, professor at USC and a developer who has been studying the impact of this mansion tax on the city of Los Angeles. He's been comparing the data between the city of LA and the county of LA, where this tax does not apply. He's here to tell us how this tax is impacting the city of Los Angeles.
The city, which has tons of budget money and tons of power, could be doing a lot more itself. And developers could really just become builders who build the housing that we need and aren't expected to solve our school problem, our road problem, our everything problem.
I'm Siamak Karami. Welcome to California Insider. Mott, it's great to have you back on. Welcome back.
I'm so happy to be here, Siamak.
We want to talk to you about mansion tax. You are a professor and developer as well. You've been studying this situation with mansion tax in LA. You have put some data together. Can you tell us what's happening with it?
Absolutely. So in November of 2022, a law called Measure ULA was on the ballot in Los Angeles, and it passed by more than 50%, but less than 2/3. And it was popularly known as the mansion tax. And this was very effective branding. It turned out it was a 29-page law that voters were expected to opine on. And it created a transfer tax, a real estate transfer tax on properties above $5 million, which to the average person might sound like a mansion, something more than $5 million. But what was not discussed publicly is that most of the properties in Los Angeles that are over $5 million are not houses. They're apartment buildings, they're retail centers, they're industrial centers, manufacturing centers, sound stages, things like this. And so really what Measure ULA did was put a very high tax, one of the highest in the nation, on the sale or transfer of high value properties. And then program the use of the money that was generated or would be generated for homelessness relief and supporting low-income households, which are very good causes that it's hard not to support.
Yeah. And how much is this transfer tax? So do people pay it when they sell the property?
Exactly right. So if you have, at the time that it got enacted, it became effective in April of 2023. It was voted on in 2022. It hit the streets in 2023. If you sold a $5 million house or a $5 million apartment building, let's say, on April 1st, 2023, you would actually have a very small transfer tax just to cover the recording in the county. But if you sold it for $5,001, you'd now be looking at a $200,000 additional tax on that sale. And if you sold it for $10,001, you'd be looking at a $550,000 tax. And it doesn't matter if you make money or lose money on the sale. It doesn't matter if you are a bank who is selling a property that you foreclosed at auction, you're paying that tax.
And you mentioned it doesn't matter making and losing money. Can you explain that?
Sure. So the tax it's a very blunt, the way Measure ULA is designed, I would say it is not a well-designed tax, unfortunately. Despite being 29 pages of detailed legal language, it doesn't seem to have learned the lessons of other transfer taxes in other areas about what works and what doesn't work. And it's based purely on the price. So for example, there was just in the news an office building in downtown Minneapolis that sold for, I think, $6 a square foot. So it was like this massive office building that sold, I think, for like
$6 per square foot?
I think it sold for about $10 million or something like this. And let's say it cost them $100 million to build it. And so now the economy has crashed. The owners of the building are probably approaching bankruptcy, if not already bankrupt. And they need to sell this building. And so they've lost $90 million on the building. They managed to get $10 million on the market, but if that building were in Los Angeles, they wouldn't even get to keep that $10 million. They would have to pay $550,000 to the city because of the transfer tax. So it's as I say, it's very blunt. It doesn't consider whether you're making or losing money. It just looks at the price and that's it.
How is it impacting the real estate space in LA?
Okay, great question. And when the tax was first put forward, the advocates were claiming that this really wouldn't be a big deal for real estate in Los Angeles because, first of all, mansions above $5 million are a very, it's a tiny share of the market, and it's consumer real estate in a sense, because if you're buying a mansion and you're going to pay $10 million for it, maybe you'll pay $10,500,000, and it won't matter to you if you're the sort of person who buys that kind of real estate, which may or may not be true, but okay. They also claimed that it would not affect apartment developers or commercial developers because people who build buildings like that, the advocates of the law claimed, build and they hold properties. And so the fact that there might be a theoretical tax at, if they sold wouldn't matter because they don't build in order to sell, they build in order to own.
And they rent them out, right? Is that
exactly
the idea?
And it turns out this is a wildly unsophisticated view of the real estate market. It's clear that they didn't speak to any actual builders or any bankers or others, because if the typical builder of a large apartment complex, 100-unit, 200-unit apartment complex, is what we call a merchant builder. So there's somebody who gets investment to build a building, get it leased up, and then they sell to another class of investor who's a landlord, basically. And so that'll happen within 3 to 5 years, usually, of the start of construction on a building.
So the builders don't hold on to the real estate in most cases?
In many cases, they do not. Some do, but in many cases, they don't. And so what Measure ULA has done is by charging this for buildings at that scale, 5.5% tax, that's often half the profit of a project like that. I mean, literally half the profit. And so people who before Measure ULA could make deals work no longer can. And the effect of that has been to significantly depress transactions and development activity in LA specifically. And that's something that we researched at UCLA.
What have you seen in terms of the data and the numbers?
Sure. So I wrote a paper with my colleague Mike Manville at UCLA, and was published by the UCLA Lewis Center, called The Unintended Consequences of Measure ULA. And what we did is we looked at 5 years of transaction data in LA County, including the city of Los Angeles. And we graphed out the number of sales per quarter, basically, starting in 2020 and ending at the end of 2024. And what you could see is we looked at sales below $5 million, and the graph basically is the inverse of interest rates, and the city and the county are moving in lockstep from 2020 through the end of 2024.
Because the county doesn't have this law, right? This is just the city of LA.
That's correct. Not only does the county not have the law, but the city of LA didn't have it before April of 2023. So we're able to see, before it took effect, city and county moving in lockstep. After April of 2023, we see that there was a massive divergence between the city and the county for properties above 5 million. If you look at the paper, you see we graph sales of properties below 5 million that are not subject to the tax, either in the city or the county, and LA City and LA County stay in lockstep. Sales over 5 million, there is about a 50% drop in Los Angeles City versus Los Angeles County, meaning that people have found ways to not sell, they've chosen not to sell. It's basically seriously depressed transaction volume, meaning that properties are not trading the way they once were. And that's a problem for a variety of reasons, which we can get into.
Why did you compare the city and county? Is it because the same investors could go to the county, or it's right there, right?
Well, it's because this, if I wanted to design a social science experiment on the impact of taxes, I couldn't have done a better job than what they did with Measure ULA, because they took two markets, LA County and LA City, which are basically, again, the same market from a practical perspective, and they imposed a very punishing tax on one subset of the market, just LA City. And so it enabled us to isolate the effects of the transfer tax specifically, as opposed to the general macroeconomic conditions which affected everything.
So the transactions, you said, is half compared to the county.
Correct.
And what does that mean for LA?
So it means a couple different things. I mean, one is people have complained for a long time about the impact of Proposition 13 on making property ownership sticky. So people hold on to properties longer than maybe they should in a place like Los Angeles. And so there aren't as many properties available for development as there would be in other markets, because if I've owned a property for 50 years and my property tax is $100 a year, and if I were to sell it, and buy a new property, my property tax would go up by 100 times or something like this. It's a reason for me to hold on to the property that I've got. So one of the things that Measure ULA did is made it even less attractive to sell. So it means that more people will decide just to keep holding their properties longer, and fewer properties will be open for development. The second thing that it means is that specifically for people who care about jobs and housing production, the raw materials for jobs and housing are basically properties, development properties in the city. It means that there are far fewer of those available than there were before, and so we should expect to see less development of industrial and commercial properties, less development of multifamily housing, including affordable housing, because the properties just aren't trading. And in fact, some other colleagues at UCLA and the Rand Corporation released a paper showing exactly that has been an effect. And then the third issue with that is that the primary means of property tax growth in LA County is property sales and development, because Prop 13 caps property tax growth at 2% a year max. The main way we get the growth in the 5 or 6% range, which is what we need in order to uphold our services and safety net, is because people are selling properties and they're getting reassessed at sale, or they're building on their properties and they're getting reassessed when properties are built. Because Measure ULA has seriously depressed both of those activities, property tax growth is basically stunted, and that's a big problem for the future.
So when people come and buy these buildings, or when people exit, the new buyers come in, they have to pay property tax at a much higher rate because it's a new transaction, right?
Absolutely. So, because again, real estate values are growing much faster than 2% a year, but property taxes can only grow by 2% a year as long as you're holding a property and not building on it. Typically, when a property sells in LA, the assessment of that property, the amount of money going from you in property taxes to the tax assessor, about doubles. So every sale basically doubles how much that property is worth to the county.
And then it would be that amount doubled every year, right? Because the taxes are
every time
paid
the property trades, or every time somebody builds on it. In other words, you buy an old car wash, let's just say, that's valued at $3 million. And you decide, well, first of all, you buy it, and chances are that the county was taxing it at a rate valuing it at about $1.5 million.
Because you bought it at maybe at $1 million 10 years ago or something.
The seller bought it at $1 million 10 years ago. And so just the very fact of you buying that from a seller who's owned it for 5 or 10 years means that it's worth twice as much to the county in terms of property tax revenue. Now, if you were going to build on it, build an apartment building on it, it might be worth $30 or $40 million when you're done. And so that building activity is going to increase the value of that property to the county by a factor of 10. And in order to support our schools, our community colleges, our social safety net, we need that property tax growth. And Measure ULA, as well-intentioned as it is, appears to be seriously depressing that.
The city is getting a lot of revenue from the transfer tax, this mansion tax. How does it compare to the loss of taxes?
So a couple of things on that. First, when the transfer tax was put on the ballot, it included an estimate that it would generate somewhere between $600 million and $1 billion a year of money for these important services. And the reality is it's generated about half of the low estimate, about $330 million a year. So still a lot of money, but a lot less than was anticipated. Now, the amount of money that it's costing the city and the county and the state, frankly, in property taxes today is, we estimated it could be as low as $25 million a year. A working paper, I should say, coming out of UC Irvine shortly is going to peg that estimate at about 4 times as much, maybe about $100 million a year. And the thing is, when we talk about $25 or $100 million of slower property tax growth, we have to think about that as a compounding and cumulative number. So take my low estimate of $25 million a year of slowed growth. This year, the city, county, state, schools, et cetera, aren't getting $25 million a year that they would have gotten but for Measure ULA. And meanwhile, the city's collecting $330 million. That sounds like a good deal. Next year, that $25 million of slower growth stays there, and then there's an additional $25 million of slower growth that the county, city, state, schools, et cetera, aren't getting. So it's $50 million. In 10 years, it's $250 million per year that are being offset by this. If the UC Irvine estimate is correct, that happens much sooner. $100 million of slowed growth a year. In 2 years, the city, county, state, schools will be losing more money than the city's making on Measure ULA.
Because the transfer tax is a one-time thing, right?
Exactly.
So then it's on transactions, and you get whatever you get every year, and you have to start over. But the property tax, it adds up, right?
Exactly right. The property tax is something you pay every year, like it or not. The transfer tax only happens when you sell. It's a one-time thing.
So you mentioned that for developers to come and build, and this transfer tax is a big deal. It's half of their profit. Can you explain to us how does it work? Why don't they add 5% more to the price?
For sure. Okay. So the way the business of building works is it's just like any other productive enterprise. There are raw materials and inputs. You kind of put them together in a way, and then you sell what you've created on the market. And a typical development, if I'm building a small apartment building, let's say it's going to be a $30 million apartment building, that's probably enough for, call it, 50 units or so. And the city of LA has an incredible shortage of housing right now, and we need all of the production of housing we can get. And so even a 50-unit project matters. It's material. We need that. We need that housing. So the way I make my money as a builder, if I buy, say, a car wash property for $5 million as my land, and then I'm going to spend $25 million, give or take, in construction costs, fees, all kinds of other things, I'll be invested to about $30 million in the whole project. Now, I'm going to want to sell the project for about $36 million, about a 20% margin, which for my 4 to 5 years of work that I'll have to put in a place like Los Angeles is good enough. It's not great, but it's good enough. Even though I want to sell it for $36 million, I'm only going to be able to sell it for what the market will bear, what people will pay me for it. And my project will still be considered marginally successful if I'm able to sell it for, a 12 to 15% margin. So at these prices, we're talking about, somewhere in the $33 to $36 million range. And Measure ULA would force me to pay somewhere between a $1.5 million to $2 million tax on my sale price. And it's not a tax on how much money I make. It's not in theory, I could lose money on the deal and still pay a Measure ULA tax. But that $1.5 to $2 million could easily be half of what I end up making in profit if I sell the property for $33 or $34 million. And so that would be a failure to most builders. If I'm only making less than 10% profit on the deal for 5 years of work, my investors would not be happy. I would have trouble paying my bills. And because of that math, a lot of builders and investors and lenders have effectively said Los Angeles is not a place that we're willing to do business right now.
And what is the impact of that? Why should we care about building not happening as much as it was happening before in LA?
We should care deeply for several reasons. One is we have a massive housing shortage that has been quantified in the hundreds of thousands of units. And What a lot of people will say sort of ideologically is, I don't care if people are building market rate units because the real need is affordable units. We need low income units because those are the ones that people who would otherwise be homeless would live in. This has turned out to be disproven by study after study, that the way the housing market works is like a game of musical chairs, where every so often, you get a job, you get married, you have kids, you change schools, you are an empty nester, you sort of get up in the game and you start looking for a new place to live. And unlike musical chairs, where when the music stops, it's whoever's closest to a chair gets to sit down and everybody else loses, in housing, it's whoever has the most money gets a seat. And the people who don't have money, no matter where they are, they get pushed out of the system. And so if we're not building housing for people who can afford it, for people who can pay the cost of housing, for middle income and up, those people are going to take units effectively from lower income families who can't pay as much. And those lower income families are going to get pushed out the bottom, and they're either going to leave Los Angeles, which has happened in great numbers, or they're going to end up on the streets, which has also happened way too much. And so we need all of the housing we can to keep that from happening, to make sure there's enough places for people to live. Another reason we should care is because of jobs. I mean, building is great work. It's high-paying, hands-on work for a huge portion of the workforce. And if we're not building, then people aren't working. And I've heard people sort of joke grimly in the building industry that the carpenters union chief say that I don't want to be the highest paid unemployed carpenter in America. We need there to be projects in order for people to get work and keep the economy going.
Now, you are involved with the builders in LA. You see the numbers of transactions. Do you think developers and builders are giving up in LA?
Sadly, I do. I mean, the conversation among the builder community is that LA is not a place to do business. And it's both because it has just become so unmanageable to make it through the bureaucracy, and also because the sentiment among some on the city council and other agencies has become sort of anti-builder, we think, where rather than the city taking responsibility for providing safety net services or for doing something as simple as improving a sewer system in a neighborhood, everything is put on builders to accomplish sort of on behalf of the city. And there's a degree to which that's manageable and a degree past which it becomes unmanageable, and we're really in the unmanageable stage of that.
You mentioned the sentiment it's kind of negative among some city leaders. What's the sentiment like from what you guys are seeing?
Well, taking a step back, if I may, I think that what we're living with is a consequence of two big trends. One of them is something that started in the 1920s, and I think we've maybe even talked about this before, when Herbert Hoover, as Secretary of Commerce, kind of popularized the way we do planning right now, which is it's all centered around turning farms into subdivisions. And the financial model of that is you have a developer come along and he or she says, I'm going to turn this farm into a whole community, kind of like happened in Irvine, for example. And part of that is paying for the infrastructure, paying for the roads, and paying for the schools, and paying for all these things. And the developer would usually take responsibility for all of that stuff because there's really nothing there. And the upside of transforming agricultural land into residential land can be enormous. I mean, 4, 5, 6, 7,000% upside if you do something like that, which is why it can make sense if you're turning a farm into a subdivision to have that sort of a model where the developer takes responsibility for everything. In that sort of suburban development paradigm, there's nothing there before the developer.
And there's a lot of margin because you guys got farmland and you're turning into housing and you make a lot of money. So
pennies on the dollar. Exactly. Meanwhile, those of us who are in the infill world, which means builders who are building in existing cities and often much more incremental projects, 50 units, 100 units, something like that, it doesn't make sense to have us build the roads and the schools and the sewers. But that's still the structure of how the city regulates. And so that culture of having the developer do everything is still very, very much part of the planning and engineering culture of most cities, including Los Angeles. So when I show up, I'm expected to take care of all of that stuff. And when you drive through LA and you see, you know, an old kind of 1930s street with beautiful buildings on it, and then there's a new apartment building, and the street widens suddenly for just the width of that apartment building, that's what you're seeing. You're seeing a city that says the developer must build the streets, and so they make you build, 30 feet of a street, which is ridiculous, but that's what happens. The second issue with the city is that there's a great sense of disempowerment among public officials, where they don't, I think it's something that's happened in our civic culture over the past 50 years, where people in government don't feel like they have the tools to directly do very much anymore. And they see their primary power as being able to find a private actor, a developer or a business person or somebody who can do what needs to get done. So instead of the city building public housing, they say, let's create a system where private developers can build public housing for the city. Or instead of the city saying, let's build the roads that we want, they wait for developers to come along and say, okay, you build us 30 feet of that road that we want. And so you end up with this really kind of disjointed public realm and public safety net, frankly, because it's crafted bit by bit opportunistically when a developer shows up. And so there is way too much attention being paid to individual projects to kind of solve all of the problems of our city, when what really should happen is the city, which has tons of budget money and tons of power, could be doing a lot more itself. And developers could really just become builders who build the housing that we need and aren't expected to solve our school problem, our road problem, our everything problem.
Now, based on what you're seeing, you've done extensive studies of Measure ULA and the mansion tax, and you've seen the transactions are going down. What do you recommend? What should the city do?
In our report, The Unintended Consequences of Measure ULA, we actually made a few recommendations. One of them would be to turn Measure ULA into actually what it was sold as. It was sold as a mansion tax, and we could make it actually a mansion tax and not tax apartments, not tax commercial centers, industrial centers, et cetera. That would preserve about 60% of the revenue to Measure ULA and turn the real estate market back on for these very important components of the market. Another thing that we recommend is to make ULA marginal. I hinted at this earlier in the conversation, but didn't go into detail. It kicks in abruptly when you cross the threshold. So when it first came into effect, a $5 million transaction was not subject to the tax at all. A $5 million $1 transaction is subject to a 4% tax entirely. So suddenly, with $1 of additional value, you've got $200,000 of additional cost, and that creates a lot of very strange behavior. Income taxes are marginal, as we say. So if you go into a new tax bracket because you get a raise, your whole salary isn't taxed at that new level. It's just the portion in that new bracket that's taxed at the level. We think Measure ULA should be marginal, so only the amount over the threshold is taxed at the tax rate. We also recommend, short of those two things, that we create a waiver for new construction projects. So if you build a new commercial building, if you build a new multifamily building, the first 15 years after it's put in service, you should be exempt from the transfer tax. That way, the way most building happens, where a builder builds and then sells to an owner, and then that owner, maybe after 10 years or so, will sell to another owner who's going to renovate it again. That 15 years should be enough in many of those cases to preserve the economics of those projects and not dissuade people from investing in Los Angeles.
If you like California Insider and the topics and the interviews we conduct, Chances are you really like the Epoch Times newspaper. We are part of the editorial team of Epoch Times. This is not just a newspaper, it's a news platform with hundreds of articles a day. We interview different sides of stories on different topics. We cover state-level issues to national to international. We have a unique coverage on China as well, and a lot of other topics that the mainstream media may not cover. We have a story in this week's edition about the tariffs and their impacts on the activity at the ports. Shippings and truckers are really feeling the impact of the tariffs at the ports. And our reporters are giving you a perspective on the ground of what's happening. Make sure to check out the newspaper. We have a special deal for you where you can get the digital or the print for $1 a week for the first month. Now let's go back to the interview. Does the politics of LA get in the middle of all of this?
It really does, because privately, many people across the political spectrum are acknowledging that Measure ULA isn't working as they hoped it would. And so they would like to change it. You know, the union workers aren't working. The affordable housing people are getting pummeled by some strange financing requirements in Measure ULA. The market rate builders of housing and commercial aren't able to work anymore. And so everybody knows that it's not working, but politically it hasn't become safe to say that publicly yet. And I'm hoping that the Overton window is moving a little bit and people will be able to speak out a little bit more. Because at the state level, Assemblymember Buffy Wicks from Berkeley has put forward something called AB 698. It's what we call a study bill, which would require future transfer taxes to do economic analyses before they're put before voters. And that bill, which made it out of the Assembly unanimously recently, could be amended to make some of the important fixes we need in Measure ULA. And I'm hoping that as it becomes safer to discuss its shortcomings, that we can craft some solutions that will preserve what's good about it, which is to the extent that it can generate hundreds of millions of dollars a year to pay for low-income households to have more stable housing and even create more housing for them, we should do that. And I'd like to see AB 698 be a vehicle for that. So Measure ULA was put forward when it was because of a couple of recent court cases which essentially poked a hole in Proposition 13. Proposition 13 says that a special tax, and Measure ULA is a special tax, needs a 2/3 vote of the people. These two court cases basically said that that is only the case. You only need a 2/3 vote of the people if the special tax is put before voters by a legislative body, either a city council or the state legislature or something like this. But if the people proposing the tax are the people, this is what the court case has determined, then it only needs a 51% threshold. And so the backers of Measure ULA kind of raced to get it on the ballot before that loophole in Proposition 13 was closed. It's still open, by the way. And the result of that is, you know, if the legislature had proposed this transfer tax, or if the city council had proposed this transfer tax, it would have gone through countless committees, economic analyses. It would have been studied, and people, you know, from the builder community, the banking community would have had a chance to look at it and say, you know, I think it's a good idea, but change paragraph number 7. Instead, what happened is version 1.0 of this very complex measure, a 29-page measure that voters were asked to vote yes or no on, made it into law. And it contains lots of idiosyncrasies that, had the backers spoken with bankers, had they spoken with builders, could have been fixed. Things like provisions in Measure ULA that make the money incompatible with Fannie Mae and Freddie Mac loans. So it's become nearly impossible to place it in service and development projects because it's incompatible with the financing those affordable housing projects have. It has resale restrictions that prevent projects that got ULA money from being able to sell to anybody but a nonprofit. And the number of nonprofit buyers in the market is tiny compared to the number of regular for-profit companies that buy and sell affordable housing. So that's created massive problems. We believe that the changes that we're proposing, which would be the 15-year waiver for new construction, if bundled with things like fixing some of the financing provisions of Measure ULA, would preserve the vast majority of the revenues. It would preserve 87% of the revenues. And it would actually make Measure ULA much, much easier to put on the street and benefit people.
Developers somehow don't have the best reputation.
Yeah.
Can you tell us about that?
Sure. Well, so it's actually interesting. So an organization that I am a part of called the Council of Infill Builders, we chose our name Builders very intentionally because that is what we do. We create physical places and cities for people to live and do business and things like that. Development has this reputation of somehow gaming the system, of somehow finding a backdoor to do something that other people aren't allowed to do, to change the zoning, to change the plans and all of this. And I think a lot of people perceive development as that, as kind of breaking a community's idea of itself and
gentrifying areas.
Gentrifying, changing the character. There's an exploitive valence that some people assign to the word developer, which I don't think is often deserved. But this is why I like the word builder, because every house that we live in was built by a builder, often by a developer. Every apartment building we live in was built by a builder, often a developer. And so I think the reputation of development is undeserved. But it's real, it's there, people have that perception, and I think we need to change it. We need people to start thinking of those of us who are creating physical, the physical spaces where people can live and work and play and do business. We need to think of them as the builders, which is what we are.
Now, what's the value you guys bring to the table for the community?
Building is a skill, and it's sort of like producing a movie. You need to know how to be able to finance stuff. You need to know how to get government approvals to do things the right way. You need to know how to hire the right team of designers and contractors and others. And you also need to have a vision for what you're doing. We all know that the world is changing, and we all know that the world needs to change. That, when you've got more people in Los Angeles than we have homes, for example, somebody needs to come in and find solutions for this. And developers/builders are people who have kind of self-selected to be the protagonists in change. I mean, it's our job to say, something needs to happen and I'm going to do it. I want to create a space for more small businesses on this main street, or I want to create a space where more families can live. And a lot of people will go to planning meetings and talk about zoning changes and stuff like this, which is good and fine, but no zoning ordinance, no urban plan has ever actually created anything. In order to create, you need to go out there and get your hands dirty and deal with all the moral complexity of it, because it is a morally complex thing when you're introducing change into a neighborhood. And builders are people who've said, I'm willing to bear that burden and I'm willing to do it, and that's who we are.
Mott Smith, professor at USC and developer, it was great to have you in California Insider.
So great to be here. Thanks, CMAC.
Let us know what your thoughts are on this mansion tax. Do you think it should be reformed? Or do you think it should stay as is? You can always email us at siamak@californiainsider.com or comment. We read all of your emails and comments. I'm Siamak Karami, this is California Insider, and we'll see you next time.